All right, so welcome to Coffee with Markus. This is episode 66, and today we're going to talk about what's happening in the market so that you know what's going on and what to expect. And I want to show you a really cool options trading strategy called the wheel. And as always, we're doing a deep dive into these topics. Sounds good? Okay, so if this is your first time here, welcome. I'm Markus Heidkotter, and before we get started, let me give you a super quick intro why I am doing this show. Because here's what I'm seeing. Most people who start trading expect their accounts to explode, and they've seen the ads and emails that promise them to turn $2,000 into $1,000,000 or something crazy like this. And then they start trading and they quickly realize that it doesn't work this way. So if you are sick and tired of all the hype and empty promises, then this show is for you, because my goal is to give you the strategies and the tools that you need to grow your account systematically, because that's what I found. That is the key. See, everybody can get lucky every now and then with a lucky trade, but being able to grow your account in a systematic and predictable way, that is the key to success in the market. So in this show, I'll show you the tools that you need. I'll give you the trading strategies that actually work, and we'll talk about the right mindset of a trader, because that is super important. Also in the show, it's all about facts and real trades. Now, talk about real, I'll show you all of my trades, winning trades and losing trades. No hype, just the facts, because I want you to succeed. And if this sounds good to you, then click on like right now or just type yes in the comments and we'll get started. Okay, awesome. Seems that everybody is ready. So let's talk about it. Let's talk about the first segment here. What is happening in the market? And this segment is for you so that you know what's happening right now and what to expect. So this morning, markets jumped higher. And you see right now, the S&P 500 is up 0.8% for the day. So we opened higher. Let me just show you a 5-minute chart here for a moment so that you see what happened. We opened higher right here, but then pretty much for the remainder of the day, we have been just diddling around. And yes, as you know, if you have been following the show, you know that this is a technical term. You see, markets right now have a hard time breaking out of this range. Let me just reset the chart here, zoom in a little bit so that you see. That's the S&P 500 just going sideways. On Monday, we had this dramatic drop. Yesterday, we had a bounce back, and today, not going anywhere. Same here in the Dow Jones. So the Dow also just diddling sideways here. And the NASDAQ, which has been on fire right now, shows some sign of fatigues. But let's talk about what happened here in the market. Why are we higher today? Why are we up almost 1%? Well, it's only 0.8% in the S&P, 0.75 in the Dow. So here's what happened. There are more good news regarding a vaccine. Moderna, mRNA, they announced last night actually that its drug produced neutralizing antibodies in all of 45 patients during an early stage trial. And the trial was 75 days long. So yeah, these trials are long, but as you can see, this morning Moderna jumped up like crazy, has pulled back ever since, but is still up 8% for the day. So of course, that is good news. And then also we had Goldman Sachs reporting earnings before the bell, and it was better than expected. So Goldman Sachs has pulled back ever since, but as you can see, nicely up. This morning, I believe they were up like 4%. So it's good news when the banks are reporting better than expected earnings. The banks actually have a very unique view on the pandemic. They say it'll hit later because they're still expecting some loan defaults. Thus far, it seems they haven't happened yet. And again, with better than expected earnings, it's all good. Now, with vaccine news, good news from the vaccine front that maybe we do have a vaccine against the nasty virus. This is when pretty much everything connected to traveling is jumping higher. So not all. If you look at American Airlines, so American Airlines today up 15% for the day. That's just crazy. United Airlines, as you can see here, up also 15%. Delta Airlines, so airlines that have been hit hard today, up almost 10%, 9.6. But also Vegas, because after all, Vegas right now is hit hard. So if you look at, for example, MGM Resorts up 11% for the day. WYNN Resorts, no, not WYNN, WYNN Resorts up 9%, almost 10% for the day. Then we have hotels, Marriott up 8% for the day. Hilton up, what do we have here? 9.5%, and also the cruise lines. So as you can see, there's a bunch of stock that today just jumped massively higher. Here, Carnival Cruise Lines up 15%, NCLH, Norwegian Cruise Lines up 19%. And as such, this is why the markets are higher. But if you look at this, it's pretty interesting. So the NASDAQ today is lagging, and the NASDAQ has been the index that ran away. So what's happening here? What are the losers of today? Well, the big tech companies are losing or are actually posting some losses today. Amazon, which has been everybody's darling, today down almost 2%. Same for Microsoft. Google and Netflix will take a look at this. So Microsoft down 0.3%, so not too much. Google down 0.5% here. So what is happening when we look at the NASDAQ here? Why do we see these big companies, big tech losing? Well, there's some profit taking because, I mean, look at Amazon. Amazon has just been on a run. I mean, this pandemic here didn't affect Amazon at all, as you know. I mean, Amazon made new all-time highs above 3,200, and right now there's some profit taking, and maybe also possible, it is possible that money is shifting, and it's shifting back into the stocks that have been beaten down, like the airlines, like cruise lines. Who knows, right? I mean, this is what can happen here. So this is definitely the focus here this week. We talked about it in the previous Coffee with Markus. No major economic reports on stack this week, so all eyes are on earnings, and thus far, PepsiCo reported earnings. It was better than expected. Goldman Sachs reported earnings. There's a few others, or quite a few others, reporting this week. So, of course, the eyes will be on earnings and also on what's happening here on the vaccine front. Anyhow, so in a moment, we're going to talk about a specific option strategy, the wheel, and you're going to love it. I just want to say hi to everybody here. So good to see Ray, Ravnat, so good to see everybody. Esther, Joyce. Joyce says, not interested. What are you not interested in? I mean, you don't have to. You don't have to watch the channel here. Anyhow, I think it's something really cool that I'm going to show you today. So let's just go to the agenda really quick and then dive right in. So today we just, for a few minutes, always spend a few minutes to talk about the market so that you know what's happening. And right now, we're talking about an option strategy that is called the wheel. And you'll see in a moment why that is. And then we're doing a deep dive into the strategy so that you know exactly how to use it. Let me take a sip of coffee here real quick and move over to the chart. So let me just bring up a different chart here. And going to show you this strategy. Okay. All right, perfect. So let's continue our discussion about options trading strategies. And today we're going to talk an options strategy that is called the wheel. And I'll explain exactly what that means. But first, let's do a super quick review if you're new to options, or just as a refresher, because it always helps. So first of all, when you are trading options, you can trade calls and you can trade puts, and you can either buy a call or you can buy options or you can sell options. So let's review it. When you buy a call, you have the right to buy 100 shares of a stock at the strike price. Let's actually talk about what happens when you're selling a call. And as you can see, I've already prepared it so that I don't have to type. So when you're selling a call, you have the obligation, not the right, the obligation to sell 100 shares, and this is supposed to say shares, of a stock at the strike price. Now let's also talk about buying and selling puts. And again, I have prepared a little bit so that I don't have to, there we go. I had it all planned out differently in my head. Anyhow, so when you buy a put, you have the right to sell 100 shares of a stock at the strike price. And when you sell a put, you have the obligation to buy 100 shares of a stock at the strike price. So if you're unfamiliar and if they say right now, oh, this is too fast, I have done an options 101 for you. And I'll post the link in the description and also here in the chat. So it's free for you. Take a look at the options 101. It will help you with the strategy here. So let's talk about the strategy, the wheel. And first of all, the idea here is to get paid while you wait to buy a stock. And this is actually the Warren Buffett strategy. Warren Buffett is using this strategy, this particular one that I want to show you. So the most important thing is, first of all, you need to find a stock that you want to own, right? I mean, this is what this is all about. And here for today, for this example, I thought we can take a look at SQ. So SQ, it's Square Inc. It's a technology service. It's a payment processor. And as you can see, SQ has been in a really nice uptrend. It has been trading as high as 130. And let's just say, for our example here, that you want to buy it when it retraces to a price of 100. You see it right here. So let's say you don't want to chase it. You want the stock to come back to you, and you never want to buy a stock at the high. So it's always a good idea when you're buying stocks to buy it when they're retracing. Now, let's just say this is what we want to do. So let's write this down here. Let's say we want to buy 100 shares of SQ when they come back to 100, and we are bullish. This means we expect the stock to go up in the long run, right? So we have a longer term perspective here. There we go. Yeah, that's pretty enough. So we have a longer term perspective on SQ. It doesn't matter. It could be Amazon, you could do Walmart, you could do Tesla. So let's just use this here for an example. Now, remember, as we're going back here, when you're selling a put means that you are forced to buy 100 shares of a stock at the strike price. So in this case, we want to use 100. So let's just say, let's switch to the trading platform. We're going to a SQ, and we're looking at an option that is around 30 days out. So right now, the August 21 is 37 days out. So here we're looking at 100 put, and as you can see right now, if we are selling 100 put, oops, let me just make sure that I'm not actually selling the shares. Let me just get rid of this. Hold on, so that you see, there we go, delete this leg. Now, of course, my mouse doesn't work. So let me just reset the whole order. There we go. Okay, this is much better. So we are selling the 100 strike price because this would mean that we have to buy the shares when they drop back to 100. Now, as you can see, let me just write this down here. So we sell the 100 put with an expiration of August 21st for right now $3.20. And since options trade in 100 packs, this means that we are receiving, because we are selling it, so we are receiving $320. Again, if you would like to know more about these basics here that are super important, I have a course for you. It's called Options 101. I'll post the link in the description. So we're getting $320. Now let's take a look at this. The broker, in order to do this, requires, look at this, he requires only $1,000 in margin. So that is not a whole lot, right? I mean, it's only a little bit because I'm trading here on a margin account. So let's just write this down. Okay. Broker requests around $1,000 in margin. Now, of course, if you don't have a margin account, so with no margin account, it would be $10,000. So a margin account in this case makes a lot of sense. Now, let's talk about two possible scenarios. And here's what I want to do. So scenario one, Actually, I have prepared something for you. Haha, look at this. So we're selling it for $320. And so after 35 days, when this option expires, and I know technically it's 37 days, but I want to make the math a little bit easier here. So this is why I'm using 35 days. So after 35 days, it could be that the stock is above $100. And let's just move this over here. If this is the case, you still do not own the stock. So your profit and loss from the stock here is a whopping 0. But since you sold the option for $350, you're making $350. So this doesn't sound a whole lot, right? I mean, $350, but keep in mind that you made this in 37 days and you only needed $1,000 in margin here. So that's pretty good. Because if you think about it, this means you made 35% in 35 days. Not bad at all, based on your margin, right? Based on your margin. And again, if you don't have a margin account, you made 3.5% in 35 days. Again, it does make sense to have a margin account here. So, and if this has happened and the stock is in 35 days still above 100, so you don't have the stock, you keep the money and you can do the whole darn thing again. So you would do it again and you would sell it now at a slightly different strike price. But let's say what happens if, because I want to go back here, what happens if the stock goes below $100? So let's say the stock goes somewhat below $100. Maybe it goes as low as $90. We'll talk about this. So if it goes around this, you're now owning the stock. Let's actually say that it goes down to $90. So let's say Square is plummeting all the way to $90. But you have a long-term view, right? We expect the stock in the long run to go up. But let's say it goes down here. So in this case, the profit and loss from the stock, since now you lost $10 times 100 shares, because again, so important that you understand selling a put means the obligation to buy 100 shares of a stock at the strike price. So this is where you would lose. So this means you lose $1,000 on the stock. Okay, let's make this red because losses are never good. But we have to talk about losses because they can happen. Let's see if I can center this. Profit and loss from the option, you still keep the $350. You don't have to give this back again. So let's write this down here. So this means that now your loss would be reduced to $650. But, super important. You need to understand this. This is open P&L. Let's write this down. It's open P&L. Only if you would sell the stock right now, then you would realize the loss. So right now you're down on the stock. And now let's see what happens. What can we do? Now that we own this stock, this is where the wheel kicks in. So in this scenario, so this would be here the scenario for the wheel. The magic of the wheel. There we go. Now that we own the stock, we start selling calls, right? Because what does it mean? We can now sell a call, and this means that we have the obligation to sell 100 shares of a stock at the strike price. And what we would do here is that the option is we sell a call that is approximately $20 away. So we would sell a 110 call with an expiration of then September. Let's see when the September expiration is. So the September expiration is September 18th, okay? So here is, let's just see right now what we would get for a call that is 30 days out and $20 above the current price. So you see here, it's right now $5.20 over $5.35. So right now for a call, we would get $5. So this means that we would receive $500 in a premium for the option. And now again, the question is, what happens here after this option expires? So the first option, 35 days, then another 30 or 35 days, doesn't really matter. So let's see what happens. So first of all, let's see, maybe the stock is still, actually, let's see. What we want to do is, let's make sure that the stock is still down to $90. So can happen, right? I mean, the stock overall we are bullish, but it could go down here. So in this case, let's just see. Let's actually say, no, you know what? Let's do it worse. Let's say it goes down to $80. It keeps going down. What the heck? I mean, what is going wrong with this stock? But it can happen, right? So now on the stock, you would lose $20 times 100 shares. So this means your total loss on this stock is $1,000. But again, this is just the open P&L. You would only realize it if you actually sell it. So let's also center this one. Let's write this down as a negative because, yeah, you're losing money. It can happen. But here, wait for this. Now, you made $500 on the option plus, remember, initially we received the $350. So plus the $350 that we received earlier, so we make $850 on the option. And again, this is where, depending on whether you have a margin account or not, this would be 85%, okay, in 70 days. And I'm making this in blue to see it a little bit easier. But let's just assume that you do not have a margin account, that you're doing this maybe in a retirement account. So it would be 8.5% in 70 days. Not bad at all, right? So, but let's talk. What else could happen here? I mean, there's 4 possible scenarios that I want to talk about so that you know exactly what to expect. So now let's say the stock goes up to $100. So in this case, if it goes up to $100, so initially it went down, but now it goes up. So on the stock, you would not lose anything. And again, this is the open P&L because you're planning to hold the stock for a long time. So it's a whopping black 0. So we make it black? Sure. Why not? Let's make this black. Stick with me. You're going to love this. By the way, if you're enjoying this thus far, is this helpful to show you a real life example? If this is helpful, do me a favor and click on like really quick, because this way I know that this is helpful and that I'm going at the right pace here. So if it goes up to $100, you're not losing anything on the stock. And again, here you have the $850. So you make this. Now keep in mind, think about it this way. This is why I love this strategy, and this is why I want you to consider this strategy. See, the stock didn't do anything. In fact, the stock went from the current price of 120 all the way down to 90 and then came up to 100. So the stock has actually gone down, but you have been making money. How do you like that? Okay, now let's talk about the other 2 scenarios, because there's a possibility that the stock goes up. So let's say the stock goes up to $105. So if the stock goes to $105, what happens? You're making $5 times 100 shares. So you're making $500. And again, this would be open P&L. So let's say that it is going in the right direction, which is what we want. We want it to go higher. And so you're making $500 on the stock. Open P&L, you're not sharing it yet. And here, again, you are keeping the premium that you received. You always keep the premium. I mean, you have received the premium. Nobody can take the premium away from you. This is being deposited in your account. So, but now let's talk about the scenario that I believe is super important. Let's say that the stock is actually going up to $120. So here is what's now super important. Keep in mind, we sold the 110 call, right? So because what we said is when the stock went down to 90, we wanted to sell the 110 call. And again, what does it mean when you're selling a call? When you're selling a call, it means now you have the obligation to sell 100 shares of a stock at the strike price. So let's talk about this. So if it goes up to 120, it doesn't really matter because you have to sell it at $110. So you only make $10 per share. And on 100 shares, this would mean you make $1,000. And the shares are gone. You now have no more shares. Your account is shareless, if you want if you want to call it this way. Good. So here we go. And let's center this actually. So if it goes up, now it's perfect because you made the 500 plus 350. So you made the 850 plus an additional $1,000. So, and think about it this way. The stock only went up to 120 here. So pretty much of where it is right now. So it means that the stock came down and came back up. So now the stock is up there. And what do you do right now? So this is where the wheel keeps turning. Let's make this a little bit bigger so that you see it. The wheel keeps turning. Do it again. Since now you're shareless, what do you do? First, let's actually write down. First, you would sell a put $20 below the current strike price, below the current stock price, and earn a premium. Now let's think about it. Let's see what happens here on your account. Yeah, right. And then once you get assigned, then you're selling calls. So this is why it's called the wheel, because it keeps turning and turning and turning, which I think is pretty cool. So you can sell a put again and start it all over. So this is a super powerful strategy that can make you a decent return, because let's think about it. So if you can make 8.5% in 70 days, so what we do, we bring up our handy dandy calculator here. So this means 8.5 divided by 7 means that you're making 0.1% times 360. This means if you can achieve this, it means that you can make 43% per year. How do you like that? Not bad, right? I mean, for me personally, I like to make at least 60%, but it's a great strategy here. So let's do a quick summary, because I think it's very important that we do this here. First of all, it's a powerful strategy that can deliver 30% per year rather safely. And by safely say, hey, you can never know. It might be that the stock keeps going down, 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 down. Of course, then you have to keep doing it, and your open P&L might show a larger loss, and you hope that eventually it goes up, right? So picking the right stock is super important. So let's talk about this. Important. Actually, I want to keep this here as an example. Oops. There we go. So secondly, it is super important that you pick the right stock. And what is the right stock? The right stock is one that goes up in the longer run, right? But you see, yes, you can do this almost forever and keep the premium, and you make more money when the stock goes up. So if you enjoyed this video and if you're intrigued by this strategy and want to learn more, I'm thinking about doing a course on this, on the wheel, right? As well as covered calls and a poor man's covered call. So it's basically 3 in 1. I haven't decided yet, but if you're interested in learning more about this strategy and attending this course, then put your name on the wait list. rockwelltrading.com/blueprint is the wait list, and there's absolutely no obligation. I just want to see if you're interested in this, because if you are, then I'll send you an email when I decide to hold this course, if I'm holding the course, which I don't know yet. And if there's not enough interest, then no worries. Yeah, no harm, no foul. Anyhow, hope that you enjoyed this video. And if you did, do me a favor, click on like, make sure that you subscribe to this channel, and please share this video. I think it's pretty good stuff. And if you would agree, that this is good stuff, share it with everybody who might find this interesting. And go on the wait list, no obligation whatsoever. I just want to see if there's interest, so that I spend the time of putting this course together, of giving you the exact rules, what stocks to look for, what criteria they have to meet. Secondly, when it does make sense to trade the wheel, what days you should enter, right? Do you enter on up days or on down days? So all of the good stuff. Okay, anyhow. And if you're watching the recording here, there's probably some videos popping up right now, and click on any that interests you, and I'll see you in the next video. Or in the class if it happens. All right, good. Now, this is fun, isn't it? Okay, so there's a lot of questions coming in. And that's my promise to you that right now, that's the advantage. If you're live here, we're now doing a deep dive together with you. So I'll take a look at your questions and see if we can go deeper and show more example and clarify anything that that might be here of interest for you. So let me actually scroll back a little bit because there's so many questions that keep flying in. So Ali Reza says, you did make a mistake. Call should be September. Okay, let me just quickly see. If I did make a mistake, I will. Sell the call that expires September. There we go. Is that what you mean? That expires September 2018. Let's actually write this down because I am from Germany, and it always throws me off this month and date first. And if you're watching this and you're international and you're getting used to these Americans writing first the months and then the day instead of the day and the months, so let me clarify it here. So I think I did it correct here. Absolutely. Steve Martin says that I did make a mistake where it says 20 times 10, 2,000. No, I am pretty sure that my math is correct here. I'll be happy to double check it. Oh, here, $20. Okay, you lose 2,000. I see what you say. You see, this is why we're doing the deep dive here. Okay, perfect. Thanks for letting me know so that we can correct it because, as you know, these show notes will be available to you. And you have to go to rockwelltrading.com/coffee. That's where you get the show notes here. Anyhow, good. So let's see. Andreas is asking, can we do this strategy on the other side with selling a put? Okay, so let me be very clear. This is a strategy for a stock. Let's actually go back here for a second. This is a strategy for a stock that you expect to go up. So Andreas, I would flip it around because the way how this strategy is intended to be traded is on bullish stocks. So, and you see, there's right now a lot of bullish stocks. So you might be bullish overall on Amazon, right? Where you say, you know what, I just think that Amazon, nobody can stop Amazon. Let's just take a look at the weekly chart here. So if you look at the weekly chart of Amazon, you just see it's going up. Or you might say, you know what, I believe in Netflix. And so in the long run, I want Netflix to go up, but I'm not willing right now to jump in at $500. I would be more interested to jump into it when it pulls back to $450 or maybe even $400. And while you wait, you're getting paid. Okay, so that's the idea here. Okay, so let's see. Marina is saying, why do you sell the call? Well, this is where, Marina, you just make your income a little bit more predictable because let's go back to our example here with Square. So because let's just say for whatever reason, and I'm going back to a daily chart here, let's say for whatever reason, Square goes back to 100 and then maybe just goes back up to 120. Let's say Square had its run, that Square is never moving higher. You never know. I mean, you are bullish here, but by selling this call, you see you're collecting $500 in premium. And you see this where, what do they say, the bird that you kill right now instead of having it in the bush? You know the idea, nobody's killing birds. Very important. No animals got harmed while producing this video here. Okay, anyhow, so this is where you're taking some money off the table. And you see, in the worst case, this is actually a worst case scenario almost. You're making this 30% per year. If the stock goes up, obviously here, you would make more. You would make 1,850, so 18.5% in 70 days. So that would actually be a best case scenario. But you see, when trading, I believe that you should always think about the worst case scenario. So what happens if it goes against you? And if you still can make money, I think that's pretty good. Okay. So, okay, Asia said, if you sell for 320, I am so sorry. Okay. It was 320. Good. So what shall we do? Shall we say that we sold it for 350. Shall we correct it here or here? Doesn't really matter. This is a little bit easier right now. So let me correct it here. And no, actually, let's be correct. You're right. You're absolutely right. No, let's be correct, even though it is a little bit more work. Want to make sure that you have the right show notes and that we are not inflating everything, because, as you know, there's so many so-called gurus on YouTube and everywhere who are inflating all the numbers. So this was not my intention. In fact, I looked at this to find a great example for you a little bit earlier. And when I looked at it earlier, it was at 350. So it was probably still stuck in my head. But we will correct it here. And then, of course, we are correcting this and this and this and this. And what does it mean? Does this mean that you make 43%? No. Now we have to break out our handy dandy calculator, which we will. So if you make 8.2% in 70 days, and we're multiplying this by 360, we only make 42%. I am so sorry for misleading you. Thanks for catching this. Asia said it. Todd also. Todd, thanks for pointing it out. Option was 320. So let's make sure. Okay, so Alisa Kani said, why $10? You make $20 profit on the call? No, because you're selling the call. And you see, this is why, Ali Reza, sorry for mispronouncing your name. It's so important that you understand what it means when you sell a call. So yes, I do make minor mistakes in math here, because math is not an exact science. Anyhow, but this one is correct. So it means that you have to do it. And we did buy these 100 shares at $100. You remember this? What happened? We had to buy it at $100, and then we had to sell it at $110. So the math is correct. I got it here. Good. Okay, Todd, thank you. Yes, absolutely. Okay. So Ray Ellis is saying, why didn't you sell the 105? You see, I see that there's a lot of confusion. So I'll get to this question here in a moment, but this is why, if you're seriously interested in this strategy and you want to apply it, because Ray, and probably you're not the only one, there's a little bit confusion, but please make sure to put your name on the wait list and say, yes, I'm interested. And that's all it is. I'm asking you for name and email address, so that if I decide to do the class, that I can send you an email and say, okay, here's the class, here's the investment in the class, and trust me, it will be super inexpensive. It will be very, very affordable for everybody. My goal is that you can make back the money that you invest the class with your first trade. Okay, that is my goal. Okay. So Ray, back to your question. Why didn't you sell at 105 if you had the 100 strike? Not quite sure what you're referring to, but the math here is correct. Trust me on this one. At first, I had the, what was it? Yeah, the 100 put, right? And later, I had the 110 call. Again, no worries. I understand that in the beginning, it can be a little bit confusing. And I went through this example quickly here because not everybody might be interested in the strategy. But if you are, then really you should consider putting your name on the wait list. By the way, is this helpful thus far? Because if it is, do me a favor and click on like. If this is your first time here and you say, oh my gosh, this is way over my head. Don't worry. Sometimes we're doing very basic concepts. Sometimes we're doing more advanced concepts. This today, I want to say, is an intermediate concept. So if you're an advanced trader, you say, I already know all this. This is why probably Asia and Todd and a few others caught a few mistakes that I made here, but now it is correct. Anyhow, so if you are a beginner, take a look at the Options 101 class. This is a great way to get started. And also, you can consider getting the book, The Forex Strategy. I'll be happy to send you a free copy. So here's the 10-second infomercial. Be happy to send you a free copy of the book that I've written on the Forex strategy, different strategy. All I ask is that you pay shipping and handling, which is $4.95. So this way you can get the book if you want. And the link is probably in the description. Okay, so Mike is saying, then when your shares get called away, you repeat the process. That is exactly what you do. This is why it is called the wheel. Because if your shares are getting called away, you do it again. And as long as you see it stays below the strike price that you sold after you got the shares, you just sell another call. So super easy. Say this, and then everybody's thoroughly confused here. Okay, anyhow, Kathy says, whoa, we'll have to rewatch this one. Sure. I mean, they live on the YouTubes forever. This is why I'm doing it here, so that you can rewind it, rewatch it. And we'll also cut out the middle segment, because I know that right now we have already been together for 40 minutes. So the middle segment, the meat of it is probably, what was it, like 15 minutes, if that. So Asia will edit it all together. Asia is my genius video editor. Make it all pretty, and we'll upload it in the next few days. Okay, so Don says, this is my primary strategy in my Roth IRA, and works great. Over 46 trades. Pick good stocks. That is the key. You're absolutely right, Don. That is the key. Pick good stocks. Andrea says, cool, but don't take a wheel on high price stocks like Amazon. You see, you can do it on AMD. You could do it on mid-price stocks like Boeing. You could do it on Apple, which is around, 300, 400 right now. You can do it on Facebook. You can do it on cheaper stocks like we have here, like on Square. So there's many opportunities. I wouldn't do it on any stocks that are below $50, because usually you're not getting enough premium. So stocks below $50 don't make sense. I personally believe that the sweet spot is somewhere between $50 and $200. But yeah, great. Good. Benito says, I was going to say rerun on this one while using a treadmill tonight. That is a good idea here. That's a good idea. Okay. Good. So Robert is asking, does it matter if the stock is a much lower price, since there are only pennies sometime? I have KO. Let's take a look at this together real quick for you. So that's why I say, if it is too cheap, KO, let's see. Coca-Cola here, $44. Let's see if we would get any premium. Let's say that we assume it goes down to maybe 43, that you say you want to own it for 43, or here. So let's just do it. Let's just take a look at this at KO real quick here. KO, and we set, what do we say? Already forgot. Like 43, 44. So you see at 42.50, it's not bad. I mean, you're getting $56. And again, this is where you have to do a little bit the math. So let me do the math for you. So example, KO, if you wanted to do it right now. So let's just see if I wanted to sell a put. You see, my buying power required on a margin account is only $541. So you would get sell, which one did we do? The 42.50 put for 50 cents. So this means you're making $50, and the margin requirement here is only $541. So this means that you're making, okay, let's break out the handy dandy calculator here. 50 by 541. So you're making 9.25% on margin. Or if you don't have a margin account, right, if you're trading it in an IRA or in a retirement account, for example, let's just see. Oops, what did I do? There we go. Then, of course, you would have to have $5,000, so it would be 0.925. So approximately, let's say, 1%, okay, for 30 days. So not a whole lot here, or 35 days, actually. So let's see, how much would that be in a year? And again, it's always important that you look at it from a yearly perspective. So 1 divided by 30 times 360. Yeah, so here you would make only 12% per year. So honestly, for me, this wouldn't be attractive. When you're trading this strategy, I would say you should look to make at least 30% per year, because otherwise, that's not what I wanted to do. Otherwise, it's probably not worth doing it. So with KO, might actually be a good idea to cut it loose or use covered calls. And I did a video on this. So if you want to see the video on covered calls, we'll link to it in the description or right here in the chat. So for you, the wheel for KO would make sense, but maybe just selling covered calls here would make sense. Okay, is this helpful? Good. And this is where we run through an example. And again, if you're interested in learning more about covered calls or the poor man's covered call or this strategy, the wheel, put your name on the wait list, rockwelltrading.com/blueprint. All right, want to take a couple of more questions. I know that we are a little bit over time here, but it's so good to see everybody here, to see all the questions here. So first of all, Zig says, let me see if I find the comment here. I just see a great comment. So Zig says, if the stock continues to drop, you could end up with a huge open P&L and will take in less premium over time. Is this right? Yes. So, I mean, so here's the important deal. We'll talk about it more in the class, but let me just, it is so important that you are looking for a stock that is overall going up. This is why I picked Square here. And how do you pick a stock that is overall in an uptrend? Well, I mean, there's different ways to look at it. You can look at it in a weekly chart, or, I mean, this is what many people do. They're using a 200-day moving average. So here I plotted a 200-day moving average. And so Zig, to your comment, if this keeps dropping and at some point goes below its 200-day moving average, I would say this is no longer bullish. So you stop doing it, right? And at this point, you should have actually, the idea here is that you have made enough money with selling options that you're covering your losses or you're sitting on a small loss. Is this making sense? Because every 30 days you would sell it again. So at some point, yes, you have to cut the stock loose. You don't want to hold on to a losing trade. So look for stocks that are above the 200 period moving average. I think this is just a good rule of thumb here. It makes a lot of sense. Okay, so there was another question from Frank. As a foreigner who does not live in the US, you live in Germany, can I use the Tastyworks account as well? Not quite sure. Do me a favor, go to rockwelltrading.com/tastyworks. This will redirect you to a page where you get more information. I do believe it is possible, but I'll look into this and I'll let you know in one of the next videos. Anyhow, hey, hope that you enjoyed today's video. I had lots of fun preparing it for you and doing it for you here today. And again, if you're interested in learning more about this strategy as well as the other two strategies that I presented previously, the covered call and the poor man's covered call, put your name on the list. And if I decide to do the class, I will send you an email. I'll let you know of when it is and how to sign up for this class. Have a great rest of the day. Please make sure to like this video and share this video with anybody who found this useful. And if this is your first time here, again, welcome. And feel free to subscribe to this channel. This way you get notified whenever I release a new video or I go live like right now. And next live, I will be on Friday, 2 days from now, 3:30 Eastern time. I'm always live Monday, Wednesday, and Friday, 3:30 Eastern time, 30 minutes before the close. Have a great day and take care.